program is brought to you by LGT Wealth Management. Welcome to the next chapter in trusted advice, where global strength and deep local relationships shape wealth that lasts for generations. LGT Wealth Management, lgtwm.com.au.
G'day and welcome to the Global View on this Wednesday. I'm Andrew Gagan. Good to have you with us here at AusBiz. Let's get across what we saw overnight. Most global equity markets gaining as investors look to an end to the US government shutdown while remaining wary of AI-related stock valuations. Those concerns saw the Nasdaq dip on Wall Street, while the Dow had a positive session, but it was those mega cap tech stocks that came to focus. Nvidia shares fell after Japanese tech investor SoftBank revealed that it had sold its stake in the AI bellwether for $5.8 billion. This as SoftBank reported second quarter net profit more than doubled to $16.5 billion, driven by valuation gains on its OpenAI holdings. Nvidia-backed CoreWeave fell heavily after the cloud computing firm trimmed its annual revenue forecast, while shares of Core Scientific also fell. Apple's market value rose back above $4 trillion, close to a record high. Health stocks rose, with US-listed shares of Danish drug maker Novo Nordisk rising as it announced cuts to the price of its weight loss drug Wegovy. Occidental Petroleum gained after the shale producer beat third quarter profit expectations. Paramount Skydance shares surged after the newly merged media company announced more cost cuts and plans to invest $1.5 billion in its streaming and studio divisions. And Britain's FTSE 100 closed a record high for the second straight session as weak UK labour market data boosted hopes of a rate cut there, while drug maker AstraZeneca rose to a record high, solidifying its position as the UK's largest listed stock by market value. Well, investors are anticipating an end to the blackout period for data, with prediction markets betting that the government shutdown will end on Friday in the US. That eventuates September's September's employment report is expected to be released at the beginning of next week, but other data releases could be delayed. Meanwhile, Goldman Sachs revising up its third quarter US GDP estimate to 3.7%. And that's based on slightly stronger consumer spending, it says, capex and exports growth, while the broker's quarter-on-quarter GDP growth forecast for 2025 now stands at 2%. And the latest US data shows ADP weekly private payrolls fell to an average of just over 11,000 jobs a week in the 4-week period to the end of October. Small business optimism fell further into negative territory, and the US Treasury physical market was closed, but futures traded with the implied 10-year yield falling around 5 basis points to 4.07%. The US dollar is down on the day. The Aussie trading at 65.3 US cents. Oil prices gained in reaction to the latest US sanctions on Russian oil and optimism over potential to end the US government shutdown. Brent crude futures up more than 1.5% at $65 a barrel. Copper tumbled almost 4%, while iron ore fell around 0.5% to $101 a tonne. And gold hit a near 3-week high, bolstered by expectations of an end of the shutdown. Spot gold at close to $4,130 an ounce. And Bitcoin trading lower at around $103,000. Now, for more on global markets with the focus of what we're seeing on Wall Street, I caught up with Alfreda Jolicoeur from Alphinity Investment Management.
Yes, it's certainly been quite an interesting year so far, with a lot of the performance in the share prices driven more by additional liquidity in the market, with the retail investors coming through quite strongly this year in particular, participating a lot more, and then also a lot of narrative in the market. For example, one that's recently been playing out is that AI is going to take over all software companies' abilities, and we think some of these are really overdone. So you have seen a lot of stock moves rather than focusing on fundamentals like cash flow, balance sheets. It's been swept up in this narrative. So there's been a lot of noise. We in this environment just sort of stick to that investment process of looking at earnings leadership and companies that can surprise on positive earnings revisions. So yes, lots of talk around AI bubbles and a lot of froth there. We don't necessarily think this is 1999. At that point in time, the top 5 companies traded at, 52 times PE, whereas currently the top 5 companies on the S&P 500 trade at around 29 times. So we don't necessarily have that sort of issue, but there's definitely a part of this AI trade that's looking very frothy at huge multiples.
All right, which stocks in particular are you seeing sort of maybe speculation has got ahead of itself there?
Yes, I think a number of these companies that sort of IPO'd or businesses that's not really making profits yet, like Palantir, for example, in the last few days, it's really fallen a lot. You have companies like Datadog, CoreWeave. A lot of these companies have run up massively, and some of them, like Palantir, trades, on a forward 160 PE. We also look at all these new IPOs that's recently, listed. One of the companies that we've looked at is a company called Fermi. They have basically IPO'd this year. They set up infrastructure, data centers with energy infrastructure combined, and then sell it on to some of the big hyperscalers like Microsoft and Amazon and so forth. But they're trading at a 15 billion valuation currently, but they're not making any profits yet and hardly any revenues at this point. So we have that sort of stage that we really want to avoid, and I think that is what we've seen in the last few months in particular, is this unprofitable tech sector outperforming the profitable side. And that is where I think investors need to really focus on which of these companies can actually make money and which of these valuations are actually looking reasonable.
So what's your exposure to the Mag 7 at the moment?
Yeah, so we still have some exposure. We have consistently been reducing Mag 7, so we overall probably underweight the Mag 7. Our highest conviction ideas there are definitely still Microsoft, Nvidia, Amazon to a lesser extent. But we also have broadened it out to other parts of the AI ecosystem. So, for example, a lot of the money that we've taken out of the Mag 7, we've pushed into other areas like a Broadcom, for example, that's very focused on very bespoke GPUs for businesses. TSMC, that's the manufacturing sitting in Thailand. And then also other businesses such as an Amphenol that sits in that infrastructure portion of the AI trade, and have recently just once again reported fantastic results. So I would say from an overall perspective, we definitely have been reducing that sort of overall exposure to the Mag 7s, but they are still delivering really strong earnings and with really strong balance sheets and way outperforming the rest of the market. So there's still a place for them, but I would say we are definitely capping that overall AI exposure in the portfolio just to balance it with other narratives that's also important in the market.
So given what you saw in earnings season, which sectors are you actually favouring at the moment?
Yes, so one of the sectors that's been one of our biggest overweights been the financial sector, and over the last reporting season we've seen incredibly strong results from most of the international banks. So on the one hand you have the US banks that's really benefiting from deregulation, a benign credit cycle, and in Europe you also have a lot of those European banks benefiting from a higher level of interest rates where they can actually see a lot of good loan growth. So some of the names that we are invested in, and JP Morgan, Morgan Stanley, these sort of businesses with investment banks associated with it are really benefiting a lot, not just from a lot of trading volume, but also the M&A capital markets opening up with a lot of deals starting to happen. And then in Europe, we really like CaixaBank in Spain and NatWest in the UK. That bank, for example, trades on an 8 times PE, which really helps a lot when you think about the valuation of your overall portfolio.
So overall, when you look at reporting season, how did you rate it, just in terms of the hits and misses?
Yeah, so for us it was actually a very strong reporting season, and if you look from an overall perspective, it was really strong in the US. A lot of companies have come through with strong revenue growth, so overall, we've seen, I think revenue growth was twice that of the long-term average. And a lot of companies are also seeing margin expansion. So looking ahead, a lot of companies were actually upgrading both capex as well as earnings. But from an overall sector perspective, it was really carried through by the tech sector and then also the financials, as I've mentioned. So overall, I would say relatively strong, but valuations are high. So at this point in time, the market doesn't necessarily have the patience for any company that's going to miss or going to guide lower. And that is where we've seen really big movements in companies doing that. CoreWeave, Palantir, some of those stocks of late, where we've seen, not a 2% drop, but a 15% drop. So for us, I think it is important, not just looking at those headline numbers that shows the US will continue to grow at sort of 12%, which is what the consensus expect, but look under the hood, because even within sectors that's seeing upgrades, there are some players that's actually seeing downgrades.
And I note that you're also underweight healthcare, for instance.
Yeah.
A very defensive sector. Why is that? I mean, we have seen those stocks come under enormous pressure. Is that sort of highlighting that K-shaped economy that we're seeing at the moment?
Definitely. I think healthcare has really been in a world of pain this year. Of late, I think they're starting to look a little bit better again. But I mean, from a regulatory point of view, I think they've really been in the crosshairs of what's happening in the US. There's been a lot of issues around tariff implications and uncertainty around that. So we have gone very underweight healthcare. We do still think there are pockets of healthcare that's looking good. For example, Intuitive Surgical with robotic surgeries are still coming through with very strong results. And then AstraZeneca in Europe is one of those that we have actually included in our portfolio. So we have been adding to some defensive. So we do have some healthcare, but we've been preferring to play the defensives through some of the staples, rather like a Costco would be one of the really strong, stable companies that we have in our portfolio.
Freddie Yonker from Affinity Investment Management. All right, let's turn to the local market just ahead of the start. SPI futures indicating a positive beginning, currently up around 0.1%. We're going to get a couple more results to us today. Aristocrat among them, also a number of AGMs to get across, including Flight Centre. We're going to cross that detail in just a moment. Stay with us.
This program is brought to you by LGT Wealth Management. Welcome to the next chapter in trusted advice, where global strength and deep local relationships shape wealth that lasts for generations. LGT Wealth Management, lgtwm.com.au.